Resilient, which owns a portfolio of regional malls and shopping centres tenanted predominantly by national retailers.
Yes, so the mix here is slightly different, and they're one of the preeminent operators in, as you said there, Bronner, in the secondary centres. So thinking here of places like Imalahleni, Kroonstad, etc., where they took malls in towns were looking a bit tired commercially and gave them the same kind of substantial glossy mall at the fringes of the town, and that has propelled them into this astonishingly large market cap.
Market cap, as you referred to, 34 billion rand, and trades on a historic yield here of 3.56%.
I got to correct you for a second. You said secondary malls, secondary areas perhaps, but they're by no means secondary malls. These are exceptional operators on the ground. I can't say any more about that. The only concern I would have is that approximately a third of their portfolio is now in listed stock. It's a strategy that has worked for them, but I'm always a little bit more hesitant when my cash flows are coming through listed earnings as opposed to bricks and mortar.
Explain
Spell that out for us. So which listed stocks are they owning?
Primarily the likes of Rock Castle, Nepi, and they got a stake in Fortress and Capital as well, and it's done wonders for them to their earnings.
Because this is part of the family of companies,
exactly.
Des de Beer and his cohorts that have internalized the net mix and broadened the scope by doing those international ventures.
The truth of the matter is they've done exceptionally well. They've timed the market very well, and they've managed to gear those listed holdings into exceptional returns. But again, I'm a property person through and through. I like the bricks and mortar delivering my earnings, and a little bit more conservative when it comes to the listed earnings delivering to my bottom line.
So even though the strategy has done well for them to this point, you're a little skeptical as to whether it can continue to deliver. Am I correct?
I think it can continue, but I don't think that the market appreciates the relative see-through gearing on holding listed. So I would always be a little bit more conservative on the rating I think it deserves. However, with that said, you cannot underestimate the quality and the ability of these guys to generate those kind of returns.
And just go back to the share price there. I mean, the performance is good. Obviously, a little bit of a downturn at the moment.
Excellent. Literally over 5 years, you don't see that many charts like that, even in the ordinary equities environment where companies are doubling and doubling and doubling the scale of their business for one reason or another. Just a question about management. Remind me, who's at the helm of this one of itself?
Oh no, that's Des de Beer.
Des de Beer. It's
Yes.
the other one, Capital, which we'll talk about in a minute, where Barry Stuhler has got his hands on the hand. So Des is the one who's most prominently associated with this team, and he is still hands-on on this portfolio.
He's hands-on on everything. I doubt if he sleeps at night, but the truth of the matter is this is his baby, and you've got to give him the credit. He's just delivered on all fronts.
It sounds as though it would be risky
Just
to bet
speak
against
to me about that
it.
yield, though, because why was the yield historic as low as that? What does that tell you about what's expected going forward?
People are expecting this exponential growth going forward. So they delivered near on 20% in recent years. And that is, I'll say the standard in the sector through time. It should be about 8.5%. These guys are delivering 20.
Okay, but you're saying some of that came from the revaluation of those underlying other equities, but then the revaluation of their portfolio insofar as the malls themselves have been valued and judged to be worth that much more.
Exactly. So that the malls have done exceptionally well, probably better than any of their peers, but not in line with the 20% continuous growth numbers. A lot of it is a see-through gearing into a listed portfolio. Some of it is, but the truth is they've created the structure and they've been able to generate those earnings. But you speak about a very low yield. Even forward, it's trading at 4.4%. Even with this exponential growth, you take several years in order to get to a similar yield to the likes of a Redefine. Quality differential, admittedly, but you get to the same level. I don't know if I'm willing to wait that many years and take that much risk in the growth being that much higher.
Does that translate into a not hot?
At the moment, purely on pricing, I would say not hot.
Paul, hot or not?
Well, now I'm in a bit of a pickle because I've come out blazing saying that I like all of these. I'm going to give them the benefit of the doubt and go with hot on account of being able to take the story just that little bit further.
All right, you stay with that.